Hello, welcome to Scope's Portfolio Manager Conference session. My name is Manqing Sun, mutual fund analyst from Scope Analysis. For today's session, I'm very pleased to be joined by one guest speaker from BNP Paribas, Jessica Tia. Jessica is the investment specialist at BNP Paribas Greater China Equities team. She's joining us on the line this afternoon from Hong Kong. So good afternoon, Jessica.
Hello, Manqing. Hello, everyone.
Today, we will tap into an asset class with a focus of a region that is under spotlight this year, as Asia is again the engine of global growth in 2021. Will China, the largest economy in the region, continue its transition towards a higher quality growth? How can investors capture the growth story? The purpose of our webinar today is to discuss if the year of the ox will live up to its name for China equities. Jessica will also weigh in on some of the concerns investors normally have when it comes to investing in this region. Hopefully, you will leave better informed and potentially feeling excited for the opportunities. At the same time, I encourage all of you to type in the question to your speaker. We will either answer them during the meeting directly if time permits, or reach out to you with more details afterwards. So you could view the full clip of replay on our platform, Scope Explorer. And let's start the session with a question on you yourself, Jessica. First of all, tell us about yourself. How long have you been with BNP, and what's your background relevant to the asset class in this region in particular? What's your role in the team?
Thank you for having me here today. I am Jessica Tea, investment specialist for Asian equities and Greater China equities at BNP Paribas Asset Management in Hong Kong. I've been working here since 2014. So all these years, I have seen the teams growing, refining their respective portfolio strategies, reinforcing their ESG integration into the process over time. So before joining the team in Hong Kong, I used to work in Paris office at BNP Paribas Asset Management, so as portfolio manager assistant for SRI fund, socially responsible investment fund. So that gave me this ESG sensitivity and ESG expertise. So prior to that experience in Paris, I used to work in Hong Kong in wealth management within the investment fund advisory team.
That's a very diversified profile. And before we dive deeper, would you quickly name 3 reasons for our European investors why China, among all the regions, deserves a special attention from investors globally this year in 2021?
Sure. China is too big to ignore today and presents exciting opportunities. To name only 3, one would be the structural changes happening in China, which drive the country's economic growth. China is transitioning from an investment-driven export economy to an innovation-driven economy, which relies on domestic consumption. So as you can imagine, there's many themes like innovation, consumption, consolidation, which are becoming the next key drivers of China's structural growth. And the 14th five-year plan announced by the government recently is going to favor many local companies in line with these key themes. The second reason is that Chinese equities is a vast liquid market bringing better return potential and diversification benefits. So with over 5,000 listed stocks, the market is large, it's deep, and very liquid. So as you can see on the screen, these markets include both China onshore, so basically the companies listed in Shanghai and Shenzhen, so A shares, and China offshore, so H shares, ADRs, etc. So the access to China's market has improved immeasurably over the last couple of years. And this acceleration of capital markets opening up will likely continue at a fast pace because the authorities seek to improve the attractiveness of investing in China. And the third reason would be that Chinese markets today are still underexplored and under-owned as asset class by international investors. So the volatile nature of the retail investors who dominate the market creates the potential for dedicated active managers to take advantage of market inefficiencies. So in brief, the structural growth, diversification benefits, and market inefficiencies of the Chinese markets offer a fertile ground for long-term investors looking for the highest growth potential and sustainable returns.
I'm sure why we are all excited about emerging opportunities that you just described. And let's bring out the elephant in the room. Many investors are cautious when it comes to invest in China, even though over the past years, the Chinese government has made a lot of efforts on internationalizing and reforming its capital market with new rules, with QFIT scheme that will allow easier access and expand scope for foreign investors. However, many Asian companies still have problems with regards to corporate governance or as a state-owned companies, especially in China, many blue chip companies are state-owned. Could you weigh in on these concerns? Do you think the market is mature enough already for a foreseeable hyped attention in a global context, or rather quite the opposite, do you see opportunities here?
Sure. So China's private sector is now serving as the main driver of China's economic growth, but it's also important to understand the evolution and the role played by the SOEs, so the state-owned enterprises, as well as the reforms led by the government to boost this China's economic transformation. So China's reforms transformed China into a global manufacturing powerhouse with considerable political influence. The role of SOEs has been important as they have been traditionally assisted the government in reforms. But since 2008, so the great financial crisis, we have seen the economy transitioning from an investment-driven export economy to an innovation-driven economy, relying on domestic consumption. So as the focus on domestic consumption and innovation accelerate, private companies start to play an increasing role in the economy. So in particular, you may probably have heard about the combination of numbers 60, 70, 80, 90. It's frequently used to describe the private sector's contribution to the Chinese economy. Basically, private companies contribute 60% of China's GDP. They are responsible for 70% of innovation, 80% of urban employment, and provide 90% of new jobs. Meanwhile, the state-owned enterprise, so SOEs, are getting highly over-leveraged because with the country's economic transformation, a number of sectors have faced excess capacity issues. So structurally, they are less efficient compared to their private peers. That being said, the Chinese government is still keen on supporting SOEs and is committed to making them bigger, stronger, more efficient. So this is particularly relevant to certain strategic sectors where government oversight is essential. So especially in defense, energy, telecom, aviation, and railway systems, the government is making great strides in implementing policies which has greatly reduced the number of SOEs through privatization, asset sales, mergers and acquisitions. The government is currently concentrated on restructuring the remaining SOEs into modern, profit-oriented corporation. So if we take the example of the mixed ownership in telecom companies, this is actually a good example. So by selling shares to private investors, the goal here is to make them more accountable and focused on generating returns on equity while retaining state control. So SOEs are frequently used as a mechanism for implementing policy, providing socio-economic stability, and building infrastructure. And if you take the example of these megacities such as Hangzhou or Shenzhen, you will see that this is clearly a good demonstration of the potential of entities operating collaboratively under state guidance. So in brief, the ultimate goal of China is to ensure quality growth of the economy instead of quantity growth. And China's private sector is now serving as the main driver of China's economic growth. The government is working towards reallocating the resources to these companies, which creates a lot of value. But at the same time, SOEs now are restructuring and they continue to play a non-negligible role in providing social economic stability. So with better corporate governance and continued structural reforms, we believe that it is a structurally positive for Chinese asset class and for investors looking for sustainable returns in the long run.
Mm-hmm. So Asia has led the way in the process for normalization during the COVID crisis, and China was the only major economy that has a positive GDP growth worldwide last year. And looking ahead, are there still enough tailwinds to support this positive backdrop in 2021?
Sure. So at BNP Paribas Asset Management, our Greater China Equities team believes that although the path may be bumpy this year, many tailwinds will help support this long-term positive backdrop, not only in 2021, but also beyond. So there's two reasons to that. First, China is stronger, fundamentally speaking. So there's a more balanced economy with a more robust consumption service sector. We are seeing also a fast-growing innovative segment in technology and life science. So with China constantly implementing structural economic reforms, the objective is to shift consumption and investment to meet domestic demand. There's also more firepower or ammunition at both at the fiscal and monetary level. So this is very helpful because in case there's any new COVID-19 resurgence or like escalating geopolitical tensions, the government will benefit from these firepower at the fiscal and monetary level. So this has been made possible because the government has adopted a more moderated approach when using these tools in the past few months. So it's very helpful to maintain stability. China is also showing better control on the debt and market risk. If we think of this shadow banking, reducing risk in the financial systems remains a top priority in China. And they're getting on top of shadow banking to limit the market risk. The second point is that China is also stronger, technically speaking. So China has been underweight by international investors for quite a long time, and now the trend has just started to reverse. Investors are increasingly looking at a standalone China allocation rather than just holding Chinese stocks via global or emerging market allocation. We're also observing accelerating reforms in the capital markets that makes access to the local market more efficiently. So I'm thinking of China shares, for example. So international investors seem to be more relieved given a more predictable regulatory landscape supported by Beijing's 5-year planning system. The renminbi strength also reflects overseas money flowing into China asset market. But last but not least, the Super QE 2.0 also has actually drove a lot of money flowing around in the world, and growth are probably more attractive compared to the near zero long-term interest rates. So in a growth scarce environment, international investors are now looking for growth. So China is the place to be.
So could you also elaborate further on the China-U.S. relationship post-election, share your view on whether it would profoundly impact the market?
Sure. So a Biden administration, in our point of view, will reduce the risk premium of geopolitical tensions. Our Greater China Equities team at BNP Paribas Asset Management believes that the volatility of the equity markets will be here to stay, but probably will be much less volatile compared to the past cycles. So it's positive for Chinese equities. So President Biden supports a return to multilateralism and doesn't believe in tariff war. He aims to seek a dialogue, not conflicts, with a more predictable approach. That market hates unpredictable things. So contrary to the Donald Trump's more transactional or rhetoric-driven approach, we believe this is a plus. So we should expect some form of normalization of the relationship. So there should be more room for cooperation, especially on the climate change topic. So as you may know, China is aims to go carbon neutral by 2060. So we should see more cooperation on this side. And also Beijing will continue to fulfill the phase 1 trade deal commitments. So this is quite positive. Generally speaking, it's still important to highlight that the U.S. skeptical view regarding China will be here to stay. We are entering a new era. China has become a strategic competitor for the U.S. with a totally different system. So a lot of restrictions currently in place will probably remain in place because today the key focus for President Biden is to focus on the U.S. domestic growth. There's so much today is on Biden's plate, COVID, infrastructure, etc., that this will have a narrow window of control to push local agenda. So unlike the previous administration, President Biden's approach is more looking for building alliances to confront China on a number of topics. This is actually a very powerful approach if it's getting right and could hurt in the long run. But it's also positive for China, at least in the near term, because building alliances takes time. And this is exactly what China needs. China needs time. China needs time to clean balance sheet from the weaker companies, to pursue the leveraging process. So this offers more breathing room for China, and it's good for the local company and equity markets. Because of the pressure from the Trump administration, we have seen a lot of companies moving some of their supply chains offshore away from China. We expect this trend to continue in the long run, but it's quite unlikely to happen fast in the short term. And this doesn't imply that China or the equity market will necessarily suffer. Now, what is important is that companies who look for efficiency and productivities, and COVID-19 is actually a good demonstration. This is showing us that China is still leading in the global supply chain, even today. So this offshore operation will work with the existing supply chain operation in China, which in turn will enrich the ecosystem of the latter and augment its status as a major manufacturing hub for the world. So to recap, we are overall actually positive in the long run, following the entrance of Biden within the White House.
Okay, so it's a positive view of the future relationship. Apart from a growth, diversification, as you mentioned, could be one of the key considerations when adding to allocation. According to a study by Scope last year, the Chinese A share market is historically one of the global trading places with lowest correlation to global stocks. Does it still hold true throughout the COVID-19 pandemic, now that China is growing the weighting share in major indices such as MSCI and FTSE? What kind of impact are we expecting here?
You're right. So over 90% of the revenue of China A shares companies are domestically driven and thus relatively less sensitive to global macroeconomic trends. For decades, the onshore market has been developed in isolation, with few foreign investors following A shares. So overall, the A shares market tends not to transmit global shocks with the same intensity as market elsewhere. In addition to a domestic retail investor-focused market, these elements resulted in a low correlation between China A shares and other global equities, as indicated by the historical correlation of approximately 0.4 between China A shares and the MSCI World Index. So this low correlation and ample liquidity mean that A shares provides an effective means for international investors to diversify their portfolio. And indeed, COVID-19 has accelerated the importance of increasing the focus on domestic demand, as illustrated by the announcement of the 14th five-year plan back in May. One of the key focus in this five-year plan is the so-called dual circulation strategy. This strategy aims to strengthening the domestic sector while still engaging but reducing reliance on the external sector to sustain stable growth and resilient investment amid the strategic competition with the U.S. So you see, with higher focus on domestic demand, the correlation should remain at relatively low levels. So while exposure to Chinese equities can appear challenging from a risk-return perspective, The diversification in the portfolio mitigates this to some extent, such as risk-adjusted returns may actually improve. So as you can see on page 7, you can see that we have actually conducted an analysis, and this analysis is showing you that adding China A shares can potentially enhance the risk-return profile for an emerging market portfolio, as well as a China offshore equity portfolio. So in this case, we're illustrating the potential benefits of adding 20% of China A shares into China offshore equity portfolio.
Okay.
And regarding your question on the A shares inclusion into the major indices, from a longer term perspective, improved international investors' access should pave the way for the A shares way to rise further. So in the case of full inclusion, A shares, so basically together with China offshore, should take the weight of Chinese equities to about 40% of the index. So in our view, this news is more than just a further opening by MSCI. It's wider inclusion in the indices is a sign of international recognition of China's market liberalization efforts. So now international investors play a significant role in the A-share market. And the expanding share of China A shares in MSCI global indices should help reinforce global interest in this market and trigger more international fund inflows into China. So we expect the MSCI inclusion of A shares to attract about $400 billion USD of inflows over the next 5 to 10 years. And rising international participation should favor the increasing institutionalization of the market, which is very positive because at the moment, the A shares market remains, for the majority, mostly retail driven, but things are evolving very fast.
Mm-hmm. So we have talked a lot about the region and asset class in general. Let's steer to your strategy, BNP Paribas China Equity Fund. Could you draw a picture of the crew from your team at BNP Paribas? How do you collaborate within the in-house research network?
At BNP Paribas Asset Management, our Greater China Equities team is based in Hong Kong and Shanghai. Our team members are local and experienced and fully dedicated to Chinese equity expertise. They are not part of a broader or global team, and they are enjoying a long track record and a competitive performance. So our head of Greater China Equities and lead portfolio manager, David Choa, joined BNP Paribas Asset Management in 2012. And since 2015, the investment team has been bolstering with 2 additional analysts joining the team in Hong Kong in 2016, then 2 more analysts based in Shanghai later on in 2018. Now we are strengthening even further the team setup as we welcomed a new analyst this year, a new analyst specialized in technology. So today our team is made of 6 experts on the ground, accumulating over 12 years of industry experience on average on Chinese equity markets. The team follows a strong team-based approach, working in a consensus-building environment. So you have 2 portfolio managers, so David Choa and the backup PM, as well as 4 analysts. Each team member is specialized by expertise rather than by sector. The idea is to focus their energy and efforts on these subsectors where the team identifies the highest sustainable growth potential. So our investment team also benefits from additional global and local teams within BNP Paribas Asset Management. So let's start with the global macro research team. So this macro team includes as well our senior economist dedicated to Greater China. Our senior economist is a very productive writer who helps our team complement their macroeconomic views on China. So although the team managed a pure bottom-up stock selection approach, this macro overlay analysis helped reinforce the team's portfolio's risk mitigation. The team also benefits from the support of our Sustainability Center team. So the Sustainability Center is made of more than 25 experts, ESG experts, including 3 experts locally based on the ground in Hong Kong, sitting next to them. So this team provides support to our investment team with ESG research and engagement activities. The team also benefits from the support of our quant team, who acts as a sparring partner for the team on quantitative and risk management issues. The team also has strong synergy with other equity research teams in the region, including our Asian equities team. So they have a monthly collaboration, and this strong synergy helps provide our Greater China equities team with a broader regional perspective to their stock selection. So it helps them inform and reinforce their high conviction level. Finally, the team is also benefiting from the support from our investment specialist team. So we are based in Hong Kong, and we're working very closely with them to market their capability to sales and clients, and also make sure that they remain fully focused on management. So all in all, we believe that our full dedication to our expertise and global footprint leverage strongly demonstrate our company's ongoing commitment to the region.
I think you sent out a very crucial information to our investors here, because Asia presents extremely favorable preconditions for active management. Many market segments are still relatively inefficient, means it takes much longer for new information to be adequately reflected in the price than is the case in the U.S. or Europe. And this is also because the equity market is often still dominated by domestic private investors, and especially in China, 80% are private investors. And that's why a local team on the ground with strong country affinity is extremely important. So, but if you click on the peer group on our Scope Explorer, you see more than 200 strategies. And BNP China Equities Fund is top-notch ranked, top-notch rated. So what do you think make your strategy unique or stand out compared to your peer?
Sure. Let me give you the three key differentiating points against our peers and who has made the success of our fund. So first is about our high conviction approach with relatively higher domestic A-share allocation compared to our peers. Today in our portfolio, we hold about 26% of A-shares, and we enjoy the possibility to go up to 70% into A-shares, 7-0, which gives us a great flexibility in this space. This is much higher compared to the benchmark and our average peers. Yes. The second strength is about our ESG integration, which is fully embedded into our process, from idea generation to risk management, passing by fundamental analysis. You will see that ESG is everywhere, literally. And the third point is about our ability to consistently outperform the benchmark in any market conditions. No matter whether you are in an up market or down market, our team has clearly demonstrated their ability to outperform strongly and consistently. So these stronger risk-adjusted returns with limited downside has been made possible with the implementation of our growth framework unique portfolio allocation model. So this is what you can see on slide 12. This growth framework model is truly one of the key differentiating points against our peers. And the objective of this is to identify companies with distinct sources of growth. So basically, the reason why we come up with this framework is because today Chinese markets are super dynamic. And instead of only looking at companies from a value angle or from a growth angle, we decided to focus on the different growth stages of development of the companies. Depending on which stage of growth you are, the revenue profile, the margin profile, the productivity can be completely different. So we have identified three main categories of growth. The first one is mode growth. The second one is transformative. And the third one is turnaround. So mode growth are basically the companies which present very strong competitive advantages. So this is the type of companies you can sleep peacefully at night because you know that the next day they will continue to outperform. Then you have the transformative name. These are probably the most exciting stories because these companies are about to reach inflection point of accelerating growth. They have implemented new technology into their process, or they are facing a changing industry landscape. They're implementing new strategies. So we're going to see their earnings growth potential increasing by more than 30, 40, 50%. So even if they represent only 20 to 30% of our portfolio weight, their alpha generation is impressive. We're talking about more than 60 to 70% of our portfolio's alpha. And the last category is the turnaround bucket, turnaround growth. So even if they represent a marginal part of our portfolio weight, these companies are very important to monitor, because these are basically the high quality companies which have faced a difficult period of time. And now we believe that they are about to regain some growth. They are back in the race because they have changed their strategy to more premiumization, or have changed their management teams. So we see some good catalysts, and we believe that this turnaround can, in the future, become the next transformative stories. So you see, this growth framework model not only helps us identify the highest growth potential, but also acts as a risk mechanism in itself. It's a very complete framework which helps us focus on risk mitigation, because if one growth category is not working, the other bucket, the other growth category, can help offset the losses. So it helps diversify the risk in the portfolio. So to recap, the three key differentiating points that truly differentiate us from our peers are: one, our high conviction approach with a higher allocation into A shares; second, our ESG integration; and third, our growth framework unique model portfolio allocation. So thanks to our consistent outperformance in all market conditions, our 5-star Morningstar fund is now ranked in the top quartile within Morningstar, Mercer, investment over time. So over the last 1 year, 3 years, 5 years, etc.
I'm also glad that our peer also agree with us on the fund rating and ranking.
But even better is that as a result of our disciplined process and proven track record, our fund has successfully collected not only awards, but also inflows. So as you can see on page 13, we have collected since 2020 over 1.2 billion USD of inflows. And this money mostly come from new institutional clients. So this has brought our fund size to over 2.5 billion USD. Basically, we have increased our fund size by more than 10 times within 3 years. And if you're wondering whether we are reaching capacity, no problem at all, given that based on our liquidity analysis, we can easily go up to 7 billion USD if we wish. So you see, the steadily growing asset base, the expanding list of clients, and the recognition from major institutions clearly speak volumes about our team's ability in meeting the needs of clients.
So could you also, while we're at it, could you also elaborate more on your ESG integration into the investment process?
Indeed, ESG considerations are critical to us. Today, ESG is at its infancy stage, but is growing rapidly in China. China is really getting serious about ESG. The last government meeting in October confirms that China will put a strong focus to promote a green economy. So they're realizing how urgent it is for countries like China to achieve this carbon neutrality target, which is a very ambitious target. We have devoted substantial resources to deepen our analysis on this new energy transition, such as EV-related supply chain. So, for example, one of our analysts has refined even more his research coverage to focus more on this energy transition theme. So this way, we can capture this mega trend. And for us, having the support from our sustainability center is a clear competitive edge. As China is putting a higher priority in fighting climate change, we will see more Chinese companies appreciating our expertise in ESG. And for us, very important to highlight that ESG is not a separate tool. ESG is fully embedded into our philosophy and process. It's at every step of the way in our investment process. So as you can see on page 15, we have highlighted the ESG presence in green. And basically today on the ground, we have 3 ESG experts out of 25 team members in the Sustainability Center team who are locally based in Hong Kong and who join our investment meetings regularly and exchange view with our team, as well as doing active engagements with companies together. But what I want to emphasize is that to us, ESG is not only a defensive tool. ESG is not only about screening out the potential bad actors. ESG is also an offensive tool. It gives us another touch point to build trust with the management. The more trust we have, the easier for us to have meaningful dialogue with them to uncover the next trends, the next momentum in the industry. So you see, ESG integration is fully embedded into our process. It's fully rooted into our investment philosophy, and this is well demonstrated and translated into our portfolio's ESG scores and carbon footprint. So as you can see on page 16, we're showing you here the weighted average of our portfolio ESG score and carbon footprint against the benchmark, MSCI China 1040. And you can see that we are consistently better than that of our reference benchmark.
So we received a question about the peer group from the audience. How is the position of the fund compared to your peer group, and which are the biggest player in the peer group? I can answer the first question, perhaps on behalf of Scope. Among all the 250 funds, the BNP Paribas China Equities Fund is rated with top A rating and ranked number 3. But who do you consider, Jessica? Which are your biggest competitors in this peer group?
Indeed. So among our key peers, we have UBS, China Opportunity. We have Fidelity, First State, China Focus. So these names are among our key peers. We also have 91, so the ex-Investec, All China solution. Given that we follow All China solution, we believe it's like a direct competitor. So yeah, these are the key peers that follow, I would say, a relatively constrained strategy. But clearly against those peers, our key differentiating factors are relatively the same, actually. And these are the 3 points I have highlighted earlier. So one is really about our high conviction level. Compared to those peers, we tend to have a much more concentrated portfolio. So for example, against UBS, I think they have 57 names, while we do manage 47. And we have a relatively high A shares allocation compared to these peers. So if I take again the example of UBS, I think they are limited to 10%. They currently hold 9%, while we have 26%. And we can go up to 70%. So that's really the first point. Second point is about our ESG integration. This is like truly and fully embedded into our process with the support of a very solid team, Sustainability Center team. So I think BNP Paribas Asset Management has put a lot of energy and efforts in developing these sustainability resources and tools. And this is clearly not something new, because we have been already looking at this ESG aspect back to 2002. Mm-hmm. And third is our ability to consistently outperform benchmark in any market condition. So we have been very consistent in our performance, which is very reassuring for long-term investors. And we believe that we have also been able to provide diversified sources of alpha, which help us being consistent in terms of performance. So the growth framework, the ESG integrations, in the process are clearly the differentiating point against our peers. Mm-hmm. So to recap, high conviction approach with A shares, ESG integration, and growth framework model allocation are the key differentiating point against our peers.
Thank you. Thanks for highlighting the 3 key different points. So on this note, let's look at your attribution analysis. We see a strong stock selection capability, which we assume is the main alpha source from 2019 until October 2020. And then in October, we see that your strategy is a highly concentrated portfolio, as you mentioned, with a growth at a reasonable price investment style. How do you deal with the value style rotation starting from November? What's your expectation going forward in this regard?
Sure. A particular strength of our Greater China Equities team, as I mentioned earlier, is really their ability to consistently outperform the benchmark across all market conditions. And this is what we are illustrating on page 17. As you can see, every single year, the team has managed to outperform the benchmark quite significantly. So if we take the example of 2020 and 2019, which were market rally in China, the fund outperformed the benchmark by more than 15% in 2019 and even more than 23% in 2020. If we look at 2018, which was correction market, with the start of the U.S.-China trade tensions, the fund outperformed the benchmark by more than 2%. And the year before, during the technology rally in 2017, the fund outperformed its benchmark by more than 4%. So you see, this is a very consistent outperformance, which is mainly driven by a strong stock selection effect, which is the major contributor to our portfolio's alpha. So this is what we illustrate on the next slide. We are showing you the 2020 performance, during which the fund outperformed by more than 23%. And if you look at the box on the right at the top, this outperformance mostly comes from stock selection, in addition to allocation decision. So our stock selection mostly in healthcare, industrials, communication services, contributed the most to our portfolio's alpha. On the other hand, stock picks in consumer discretionary and IT slightly offset those gains. So this is very encouraging, and this is perfectly in line with our investment process, which is following a pure bottom-up stock picking approach. And what is even stronger about our capability is that not only they managed to outperform the benchmark consistently, but we also managed to outperform our key peers. So if you look at the next slide, this is showing you the analysis from eVestment. The picture is the same, actually. If you look at Morningstar or Mercer, you will see that our fund outperformed. So not only its reference benchmark during these drawdown periods, but also our average peers. As you can see on slide 19, we are ranked in the top quartile, well ahead of the benchmark. And in a volatile market like China, it's very reassuring to see that our team managed to be less volatile compared to the benchmark and the average peers. So as a result, we generate stronger risk-adjusted returns, especially Sharpe ratio, information ratio are at the top level. Our strategy is ranked in the top quartile and even in the top decile in terms of risk-adjusted returns. But the most important column here to look at is probably the last one, which is showing you some risk metrics. So in this case, this is the downside market return. So this is a very interesting risk matrix, which is showing you how we perform during downside markets. So the higher, the better, because it means that we're doing less worse compared to the benchmark or average peers. And as you can see here, according to this investment analysis, our strategy continues to rank in the top quartile. So not only our capability, our strategy is generating stronger risk-adjusted returns against our average peers and key peers, but also generate limited drawdowns. So it's truly downside resilient.
Okay, so where do you see the best investment opportunities across sectors at the moment? Could you highlight some investment themes for our investors where you see great potential and maybe give us some examples?
Sure. So China is very dynamic because the market structure is shifting very quickly. Lots of new business models and products are emerging, and the gaps between good and average companies are widening. So as you can imagine, the speed of such divergence is accelerating. And for us, is actually a perfect, ideal hunting ground for high-skill active managers with proven track records. So we believe that the following investment opportunities will continue over the next few years, and the sectors which should benefit from these three structural trends are positioned for sustainable growth. So we are focusing on these three themes, which are one, technology and innovation, second, consumption upgrading, and third, industry consolidation. So let's start with the first theme. China today is shifting from cheap labor-based manufacturing towards medium to high-end manufacturing. And this is further supported by the size of the domestic market, by higher R&D spending, but also a vast talent pool. The tech boom is not only benefiting the new economy sectors, but is also helping traditional industrial and manufacturing sectors. Innovation today go well beyond technology. It's not only about hardware, software, it's also impacting most sectors across the economy, such as consumer, healthcare, or other non-tech companies. So we see opportunities in a number of sectors, including industrial automation, capital goods, and new industrials, especially in the EV-related supply chain. Second theme is about the consumption upgrading. We see significant growth opportunities for leading companies in sectors such as healthcare, education, insurance, premium consumer brands. And a number of these domestic winners are now emerging as multinational corporates. So this is mostly supported by the rising household incomes, low household debt, more diversified consumer profiles as well. This is likely going to continue and accelerate in the next 5 to 10 years. The last thing is about industry consolidation. This consolidation trend in China has been occurring in recent years, mostly driven by regulatory tightening on new capacities, but also due to environmental cost pressure, higher financing cost, upgrade of industrial structure, and also consumer upgrading. So as the pace of growth in China is moderating after a decade of rapid expansion, companies today in China need to think more about the other side of the equation rather than just looking at the revenue. They need to focus more on R&D, on productivity, on cost. And we believe that those companies which would present a progressive mindset will increasingly stand out of the crowd, and they will drive consolidation in the market. So this will happen not only in the old industry sectors impacted by the excess capacity issues, but also in the new economy. So for these themes, the sectors that we focus mostly on is cement, property, or machinery. So you see these three key themes first are very important because they will stand the test of time regardless of all these external factors like pandemic or trade tensions. And these themes today are in our portfolio are the guiding stars of our stock picks in our long-term portfolio strategy. Last but not least, these three themes are perfectly in line with the government's 14th five-year plan, which has been announced recently, and where they focus on green economy, manufacturing revitalization. So this augurs well for sectors in environmental protection, in healthcare, AI, new infrastructure, renewable energy, etc. So perfectly in line with our long-term portfolio strategy.
Yeah, I'm sure the policy-oriented strategy is also very important for investing in China. Let's talk about risk management. China equity does exhibit higher volatility when compared to the U.S. and Europe counterparts. Can we expect a decline in volatility now that China is on its way to become a main asset class globally with its inclusion in the indices? How do you integrate long-term conviction investing with downside protection? What do you think about the overall risk for your portfolio?
I think, first of all, on this, the market change, Supported by China's opening up of capital markets and also inclusion of China shares into the major indices, we are seeing rising interest from international investors. And so, as mentioned before, rising international participation should favor the increasing institutionalization of the market. So this will probably reduce the volatility in the onshore market, at least in the long run. So this is the positive aspect more at the Chinese equity market level. Now, how do we pick our best ideas, and how do we monitor the risk in our portfolio at BNP Paribas Asset Management? So at the portfolio management level, risk management and controls are embedded throughout our process, with emphasis on the portfolio implementation process, including ongoing review, weekly meetings, monitoring of portfolio risk. Our investment process focuses on the high-quality growth companies through fundamental research, and our extensive screening and analysis of the universe help reduce the risk by selecting companies with strong business models and superior management. We also pay particular attention to valuation, which help us to limit the downside risk in our investment. So when we conduct our fundamental analysis, we will focus on 4 main factors. One is company and industry dynamics. Second is balance sheet strength. Third is valuation. And fourth is ESG assessment, which is applied prior to any investment in our portfolio. And there's another aspect which is also very important is our growth framework model allocation. As I described earlier, not only this helps identify the highest growth potential, but it also acts as a risk mechanism in itself. It's a very complete framework which help focus on risk mitigation, because if one growth category is not working, the other growth category can help diversify the risk and offset the losses. So this is at the portfolio management level. The investment team also benefit from multi-layered risk management with the support of additional teams at BNP Paribas Asset Management. So with the support notably from our Sustainability Center, our Quant team, our Global Macro Research team, as well as additional equity research teams. And so that's really the how we manage the risk in the portfolio. So to recap, risk controls are done at the portfolio management level with a diligent fundamental analysis, and our growth framework acts as a risk mechanism, and with additional support of other teams within the firm.
We've got a question from the audience. Please repeat the 4 factors of risk management. Industry dynamics. What are the other 3?
Sure. So in our fundamental analysis, we will focus on 4 factors. One is company and industry dynamics. Second is balance sheet strength. Third is valuation. And fourth is ESG assessment.
Okay, I hope this recap answers the question. So let's quickly wrap up today's discussion with 2 questions. With what's your take on those questions? We know the Chinese companies are raising R&D spending and becoming more innovative across many sectors. However, we do see tighter domestic controls of technology companies on some of its bellwethers and greater oversight on IPOs. Just recently, they killed the IPO of Ant Group of Alibaba. What other impacts would it curb enthusiasm and development of innovation sector in China?
Indeed, this is a hot topic, and it's very important to note that Beijing has prioritized financial stability, especially by deleveraging. They have started this deleveraging process since 2017, but post it with the start of the U.S.-China trade tension in 2018, and then COVID in 2020. But now that we are seeing actually a stronger economic recovery in China, now Beijing is more confident about this recovery, and they want to deleverage the system again. So they are related to these fintech platforms. There are numerous regulatory and lending reasons to supervise the fintech platforms. I think the first reason is really about limiting systematic risk. the recent tightening control on the fintech platform, like this last-minute pull-off of Ant Group, was needed to limit the financial risk coming from non-bank lending. So same as what we have seen in 2016 and 18, when the regulator has done a clampdown on the peer-to-peer lending. Now, the idea of the government is to tell everyone that the financial institution should set up early warning and loss-bearing system. The Chinese government is retreating from implicit guarantee. They're not here to help anymore, so it's very important that every company is adamant about their corporate governance and fundamentals. So here there's a number of the fintech firms until end of last year were not regulated, and so actually like enjoyed a free ride of lending, in China, and it has actually created some started to create some systematic risk in the system. So that's why the government, it's actually a blessing in disguise. The government has decided to get back to these reforms to make sure that this will not lead to any future systematic risk. And so fintech firms that are still doing loan facilitating business won't be affected, as they bridge the gap between banks and borrowers. For example, there are some fintech firms which provide like credit ratings advice, but the players which are very aggressive going into more banking type of system are more targeted by the regulators. So what we can expect from this regulation is, one, more financial regulatory oversight. Second, a retreat from implicit guarantee. Third, shareholders should bear the brunt of financial failures. And fourth, and this is very important, fintech development will not be killed, though. Indeed, fintech and government cannot live without each other, because fintech can help also bring and boost the economic growth and drive the domestic demand. So it's going to, related to your question, is it going to curb enthusiasm and development of innovation? Clearly not. So development of innovation will continue, in our view. Technology is and remains a hot segment in China, even more amid this U.S.-China growing tensions, for three main reasons. One, the sector in China is more diversified. Now you see many leading companies rather than just one winner. So for example, if you take the e-commerce example, you can find many leading players in e-commerce in China, and not only one. Tech development in many sectors is still in its infancy stage, and we observe fast-growing companies across the whole value chain, from upstream to downstream, from hardware to software, etc. Second, we're also seeing a shift to applications for businesses. Historically, China's tech focus has been on consumer applications. Now it's shifting to applications for business, where there's a huge catch-up potential compared to global peers. And third, traditional sectors. Don't forget about these. It's not only about tech enablers in China. China has a huge traditional industrial and manufacturing sectors. So brands and companies that leverage on digital transformation to improve brand image, to gain new sales channels like online, or improve productivity, are winning market shares. And they are the secondary beneficiaries of the tech boom.
So should investors, last question on my side, should investors look at specifically pure China A shares investment or an all China solution, including both China onshore and offshore equity markets?
Indeed, that's actually a great question that many investors are asking, whether should I go for an all China or a pure China A shares, given the great dispersion of return offered by China A shares. It's very important to understand what you can find, what are the investment opportunities you can find in each market. So If we look at Hong Kong companies, Hong Kong listed companies historically have been dominated by large state-owned enterprises in the financial and energy sectors, but we should not forget the non-negligible part played by tech companies. You have plenty of tech companies, actually, among the big ones, listed in New York Stock Exchange and Hong Kong Exchange. So this is the first thing. In China offshore, we found a growing number of technology and technology-related names. I'm thinking of Alibaba, JD.com, NetEase, Pinduoduo. They are all based, listed in New York, as well as in Hong Kong. So over the last 5 years, indeed, some Chinese tech giants have announced a secondary listing in Hong Kong amid growing tensions between the U.S. and China. In contrast, if you look at A shares, one attractive attribute of A shares is their higher exposure to non-government-owned companies, especially in consumption, innovation-driven industries. If you look at Shenzhen Exchange, it has a more attractive selection of companies, given that you have about 62% of Shenzhen's market cap in technology, consumer goods, and industrials. But most importantly, it's worth noting that a number of these sectors can be unique to A shares or unique to China offshore. As you can see on page 23, for example, if we are looking for Chinese spirit brands or pharmaceutical companies providing diabetes treatments for the aging population, China onshore offers much more choices, while China offshore doesn't have many opportunities there. So you see, A shares and H shares can also offer different, unique investment opportunities. We believe that the behavior and market characteristics of onshore and offshore will gradually converge, but each has their unique set of opportunities. So if you focus only on one particular market, you may miss the opportunities in the others. So having exposure to both China onshore and offshore offer you actually diversified investment opportunities. And our investment teams at BNP Paribas Asset Management finds ideals regardless of where the firms are listed, given that we believe all China is the best approach going forward. So to conclude, by investing in both China onshore and offshore shares, investors can benefit from one, broadened opportunity set for alpha generation, and second, risk management via this sector diversification.
Okay, so I'm going to take the last set of questions from the audience. If you do have other questions, please do not hesitate to shoot the question, and we'll collect them and reach out to you later on. So there's one more question on the ESG. Do you really think that China investments could fulfill sustainable criteria according to the European regulations? The social and government criteria in particular appear difficult to fulfill.
Indeed, this is one of the key challenges in China. We are, as mentioned earlier in the presentation, we are at the infancy stage, only the beginning. And today, ESG analysis in China is complicated by the low level of data availability. When you think about it, before 2018, there was zero coverage in terms of ESG in the Chinese companies' reports. Annual reports and semi-annual reports. So overall, China has been impacted by weak corporate governance standards. But things are changing very fast over these past few years. Disclosure and coverage have improved very rapidly. There's, for example, a change in reporting requirement. Now in Hong Kong, the listed companies need to disclose and have to disclose these ESG risk into their annual reports. Mainland China is also intends to do the same. Actually, if there was no COVID, this would have been done actually in 2020. So now things have been postponed, but they are getting very serious on these ESG risk and opportunities. And as I mentioned earlier, now the 14th five-year plan announced by the government is one of their key focus is the green economy. We have seen green finance developing very fast, but tackling climate change and focused on the green economy is a challenging target. And so the Chinese government is getting really serious about that. Plus, 2018, we have seen A shares, including the MSCI indices. Then we have seen S&P, FTSE doing the same. So coverage of China A shares are increasing. So things are progressing very rapidly. But obviously, it will take time. And today, I think in China, it's still lagging compared to the international standards. So that's why it's very important to have a well-resourced team looking at these ESG considerations and truly embedding these considerations into their process. And this is a particular edge that our team is benefiting from. We enjoy and benefits from the support of our Sustainability Center team, a team of 25 members, including 3 experts locally based in Hong Kong, helping our team on a daily basis in this ESG integration and active engagement activities.
Okay.
Not only to how can I say that? Not only to like exclude, company, the bad actors from our investable universe, but they are there also to fill the gap, to complement our analysis, and this is super important because today you cannot rely only on the ESG scores provided by external providers. You will see that sometimes there's a lot of lags, a lot of biased results because China is not disclosing enough on these ESG aspects. And so sometimes you end up with the bad ESG scores. But what we have realized through our deep analysis is that these ESG scores doesn't necessarily reflect the ESG performance. And so once again, it's very important to have a well-resourced team to look at this ESG analysis, to complement this ESG analysis with the support of our Sustainability Center team, and to go through active engagement activities with the companies we have high conviction in.
Okay, thank you very much, Jessica. It's a nice closing with ESG concept. Unfortunately, in the interest of time, we have to stop here. And China equity is a vast liquid market with better return potential and diversification benefits that is still yet largely underinvested, has now set the stage for the hope of a bullish year targeting for high quality growth story. Again, many thanks to our guest speaker, Jessica Tia from BNP Paribas Greater China Equities team for such brilliant presentation. It is a very lively discussion, and please do not hesitate to shoot the question, and we will collect them and reach out to you. I hope you all enjoyed today's Scope Portfolio Manager Conference, and have a wonderful day, and see you next time.
Thank you, Manqing, and thank you, everyone.
Bye.